Hey everybody, it's Pete Carmasino again, just here talking about markets. We're looking at some ratios and different setups here. We've got a nice rally here into the holiday week, or I should say, starting at least into the holiday week. And I think that was expected. A lot of tailwinds coming into year end, seasonality, you name it. We've got the Fed easing rates. We've got AI trade basically reinvigorated from Micron. We've got a lot going on. I mean, look, these things are going to tend to play out now. There's a lot of folks out there talking about doom and gloom. And as I said this many times, and if you look at some of the other work I do out there, you'll find that people like to doom scroll, right? Everybody does it. You don't need to do it. You can find everything that's going to agree with you. If you want to look for it, all the negativity, it's out there. But if you can at least peel back the onion and kind of understand exactly what's happening. We've got a lot of tax incentives here that we have not seen literally for almost 100 years since the Harding and Coolidge administrations in the 20s. We've got tax incentives here coming into this year that are just about to kick in. No tax on Social Security up to certain limits. And again, I'm not a tax advisor, nor am I giving you any financial advice here. But the point is that this is another thrust in the market that could obviously push us into territory that we have not seen ever in the S&P, Dow, and certainly even in the Russell 2000 and 3000. So what I'm saying is that follow the trends, look at what's going on. We're going to look at a couple of industries and sectors here today, but I'm going to look at a couple of different charts. A lot of folks had started posting sort of the equal weight staples and discretionary sectors. So I typically look at the QQQ and the consumer staple as it stands through XLP, the ETF. And I said that should hold 7.5 and bounce, and that's exactly what we got in the last couple of days. But I'm also going to look at the equal weighted version of that and just to see what that looks like as well. It's very similar. It's identical almost, but a lot of folks feel that it's less cap weighted and, a little bit less skewed in one direction or another. But honestly, it's moving in the same direction. So I like the idea of putting the Qs over the XLP, but I'm also just going to take a look at some sectors here in the market just to see how things are kind of shaping up here, not only for this year, but even into 2026, at least the first quarter or so. All right, let's jump on the charts right now. Real quick, we'll just start with the QQQ over the XLP. As you can see, I had a number at around 7.5 on this ratio. Again, this is basically just the Qs divided by the XLP ETF. And so what you should be seeing here is an ETF that's obviously, or should I say a ratio that's obviously in a bit of a downtrend here in the near term, okay? However, if you're zooming in, now you zoom out a little bit, you can see that it's really much more of an uptrend than it is a downtrend recently, but it does have these moments of downtrending activity followed by movements higher. And so this isn't a prediction. It's nothing more than more of an observation, but look at this bounce. I mean, 7.5 is where I just saw some natural support right around 7.5 around these recent lows. It hit it once, twice, 3 times, and then really started to move higher. And not only did it move higher, but it moved above what I was building as this wedge. Now, I talked about this being a signal or a noise, or just a noisy sort of situation in the market. Really, at this point, as I said, seasonality is on our side. We're at the year end. We got Santa Claus rally, you name it. There's all kind of names for this week that we're experiencing. But on the other side, it's going to get less volume as well. So less participants every day as we get into the Christmas holiday on Thursday, and even Friday after Christmas is probably going to be pretty slow volume wise, maybe not activity wise, but at the same time, I like what I'm seeing here on this setup. I like to look at the S&P. That's my middle panel here, just to kind of see how it's tracking between these two, these two ETFs, this ratio that I follow. And then down here is just a slope. I look at the slope of the 150 here on this chart of the ratio. So I'm just trying to gauge just the temperature, the pressure, which way is it moving higher or lower. This really squeezed below this long-term trend. And again, when you're doing this on a ratio, the ratios don't know that you have a trend line there. It basically moved higher without this slope breaking down. And I like to see that. That to me can be a continuation into more risk on versus risk off. And last week, I also talked about some sectors here that I thought you should be taking a gander at and actually adding to your watch list. And one of them was the banking sector. You can see this is shaping up, obviously, versus the S&P. There's the ETF itself, KBE, S&P Bank ETF. Moving into new highs, actually staying there, maybe even squeaking out a little bit more of a move higher, up almost 0.6% today. And the ratio, although it looks negative here, this movement higher is actually very favorable in this banking index and ETF right now that I'm following. So I still like this one. We're going to look at the KIE next. That's the insurance one. All right, the KIE also shaping up, as I said, big range here, very much range bound, really between December of 2024 all the way through December now. Finally starting to move higher. Really never broke down, to be honest. I mean, looking at this chart looks interesting. Ratio needs a little bit more work here, but this is holding steady. I like the idea of this group. To me, it just seems like a strong setup, most likely a lot of strong stocks inside of this KIE ETF, which is a great idea if you want to start finding ideas from individual names. That's what you do. Try to find sectors that are looking strong, and then open up the ETFs and see what's inside there, see what's driving it. There's got to be a reason for it. Each ETF, an equity ETF, I should say, or any ETF, but specifically an equity ETF, is basically a portfolio. So go in there and see which ones are performing and which ones aren't. Run through the charts, do the work. You're going to find some great ideas in these areas. I'm going to look at one more sector before we go. All right, I said I'll look at one more sector, and it's going to be the technology sector. Why not? I mean, this is what's driving most of the index returns here. The middle panel is the US dollar index. I've talked about this on some X.com posts, so follow me on X as well to find that. But Warren Buffett was talking about the decline of the US dollar, going long some Japanese yen, things of that nature, just some foreign currency trades. But he hasn't been wrong. He said this sometime in May. It moved higher, but obviously lower, down about 6 or 7% since he said that. And this dollar trade is obviously going in the opposite direction of what's happening in tech. Look at the Mag 7 down here. So this is the tech sector inside the S&P. This is just the Mag 7. It's an ETF. It's symbol MAGS. You can follow that as well. And you can just see the power is there. I mean, there's nothing really slowing down in the Mag 7 and technology in general. Both look very similar. Both look healthy. The uptrend is intact. And so that's what we're going to be focusing on here for the rest of this year, which is not many days left, and most likely into Q1 as well. All right, listen, thanks for watching. Subscribe if you want to follow me. I'm going to start doing these more regularly. I'm just kind of getting started with my cadence, my rhythm, and what I want to be talking about. But there's just so many things to kind of share. I just want to build a base here and really build off of this and pivot into new and better content. So please follow me, and I'll be back to you real soon. Take care.